The third area we will investigate is profitability. Profitability calculations are used to determine the overall financial health of a company. Profit is a function of revenue less costs. To understand how to calculate this, we must first understand how to calculate revenues and costs. Revenue is the total income from the sale of goods or services. This is essentially the quantity multiplied by the price of the goods sold. Total costs are a sum of fixed costs plus variable costs. In most cases, fixed costs are given. However, you may need to calculate the variable costs of a company. Variable costs are a factor of the variable cost per unit multiplied by the quantity of goods sold. Finally, profit margin, which is displayed as a percentage of total revenues, is equal to total profits divided by revenue. To provide an example of how these formulas can be used in practice, let's walk through a profitability problem together. The example is: a local toy store sells 10,000 kids' toys at an average price of $20. They purchase their toys from a distributor for $5 each, pay $20,000 a year in rent, and have 3 employees that earn $30,000 per year. From this example, we have been asked: 1. Calculate the total profits per year, and 2. Calculate their current profit margin. The first question we will solve is: what is the total profit per year? To solve this question, we will use the formula of profit equals revenue less costs. Firstly, we must calculate revenues, variable costs, and fixed costs. Once we have these figures, we can then calculate the toy store's total profit. From the prompt, we know that the toy store sells 10,000 kids' toys at an average price of $20 each. Therefore, revenues will equal $200,000. Secondly, we know that they purchase each of these toys from a manufacturer for $5 each, meaning their cost of goods sold per unit is $5. Therefore, we can see that their variable costs per year equate to $50,000. Finally, we found out that the toy store has 2 types of fixed costs: rent and wages. Their yearly rent costs are $20,000 and they pay 3 employees $30,000 each a year. Therefore, fixed costs are $110,000 per year. From this information, we can then calculate profits using the formula revenues less costs. Therefore, profit per year is $40,000. The second question we will solve is: what is their current profit margin? To calculate this, we will use the formula of profit divided by revenues. Using the information we previously calculated, we can see that the toy store's profit margin is 20%.